A derivative. A term that was often referred to in the news during the height of the credit crunch. A financial instrument that is arranged, traded, bought, and sold to create as much profit as possible. But what exactly is a derivative? Joseph B. Dial, a former commissioner at the Commodity Futures Trading Commission, described derivatives in a speech as, and I quote, "Derivatives involve the trading of rights or obligations based on an underlying product, without necessarily directly transferring that underlying product." Now, if you don't work in the financial world, this may not leave you beaming with understanding. In what has become an oracle of sorts in the modern day era, if we go to Wikipedia, it describes a derivative as: a derivative is a financial instrument, or more simply, an agreement between two people or two parties that has a value determined by the price of something else, called the underlying. It is a financial contract with a value linked to the expected future price movements of the asset it is linked to, such as a share or currency. Again, this may not leave the explanation any clearer. A derivative, putting the detailed description to one side, is simply a bet on a contract. As an example of something that is like a derivative, imagine a horse race. Now, a person who places a bet on a horse would be the buyer. The track who takes the bet would be the seller. Once the bettor or buyer places a bet, the track or seller is obligated to pay the buyer a sum of money if a specific event occurs. For example, if the horse the buyer bets on comes in first. The amount of money the buyer gets depends on the type of bet and the underlying variables, which could be how much money the track collects from all the buyers on the winning horse. So here there is the buyer, seller, the event, and the underlying variables. And in this case, the track, or the seller, is obligated to give the buyer a certain amount of money if a specific event occurs. The profit literally deriving from the obligation. In an example as something that happens very similar in real life, imagine a farmer who produces wheat. A bank, investment company, or possibly an individual could approach this farmer and offer to buy next year's wheat at $100 a ton. The present rate could be $100 a ton. The farmer accepts this because it guarantees he will sell next year's crop. The buyer accepts this because he or she thinks the price of wheat is going to rise next year to $110 a ton. Meaning the buyer can sell a ton of wheat for higher than $100 a ton, making a profit on each ton of wheat. Therefore, the profit, or possibly the loss, literally derives from the obligation between the buyer and the seller and the future price movements of the underlying product, which in this case is the wheat. Derivatives can also be arranged on companies or deals that are expected to fail as another way to make money. Take for an example an imaginary character called Bob Johnson. Now Bob is accident prone. In fact, he lives in his basement and is scared of electricity and only uses candles for lighting. Now it is highly likely that Bob will burn down his house. So, having a keen eye for money, a party or individual could take out an insurance policy on Bob's house, knowing that Bob is likely to burn down his house within the next 1 to 2 years. Thus, there will be a payment for the person or party holding the insurance policy. Of course, there is one distinct difference between a derivative in this sense and an insurance policy. You cannot take out an insurance policy on someone else or someone else's property. However, In the financial world, a derivative can be arranged on another company, bank, deal, or contract, or even another derivative. One of the main reasons the credit crunch was so severe was because of derivatives, a financial instrument that is nothing more than a bet.